Hello everyone, and in today's video we're going to look very quickly if bond market became complacent with Federal Reserve. First, let me explain what do I mean by complacent. In the current economic theory, there is a dependence between the interest rates and inflation. So according to economics, if you increase interest rates, means the inflation should go down because of higher credit costs. That's how the former Federal Chair Paul Volcker broke back of inflation in 1980s. So if you can see on the chart on the screen, in 1980s, prices in US went way up to 15%. It means year-over-year change for official CPI number, which we know normally understated, went up to 15%. What Paul Volcker did, he increased the federal fund rate, which is the interest rate from Federal Reserve. Federal fund rate at that time went almost up to 20% in order to break back of inflation. As you can see from the chart, after interest rates increased dramatically, prices started to slow down and drop. At the same time, 30 years treasuries rate went up accordingly, because the main equation for 30 years treasury is supply and demand, and if the interest rate on 30-year treasuries goes up, it means the value of this treasury goes down, and this percentage difference would be paid to a holder of this treasury as a coupon payment annually. So I compiled all these three graphics together: federal funds rate, 30 years treasury yields, and CPI. So from this graphic you can see that federal funds rates were going down for the past 40 years, where the CPI remained more or less stable on the level of 2.5%, and treasury yields were dropping down steadily during the past 40 years, which means the value of bonds had increased. So to tell it differently, bonds had a bull market for the past 40 years, while at the same time Federal Reserve continued to reduce in their interest rates without going negative yet. What is interesting is to see what did bond market do and Federal Reserve did with interest rates in, for example, global financial crisis. When inflation went up 5%, you would think that they would try to counteract it by increasing the interest rates and treasury market would sold off, because if inflation is on the level of 5%, it means by owning treasuries you actually lose money in the long term. So it doesn't make sense. Treasuries would sell, therefore driving treasury yields higher. But it did not happen. Quantitative easing did not drive inflation. As you can see, inflation still remained on the level of around 2%, while the interest rates remained at zero and bond prices continue to rise higher, means yields continue to fall lower. In the current recent episode, 2021, we see that inflation went up to 5.4%, while federal fund rate remains at zero and treasuries remain on a low level. So what that means? It means that bond market expects again that inflation is transitory, that those 5% will go down again eventually, and bond market will be driven higher, and the bond will be driven even higher as treasury yields will go lower and Fed fund rate might even go negative. So there are a lot to unpack there. But if you ask my opinion, what do I think about the bond market? Is the bond market complacent with the Fed? If you ask me, I would say yes. Why do I think that? For a few reasons. Bull market for the past 40 years. People who started to work in the bond market experienced only bull market for the past 40 years. It must do something with their psychology. Huge shortage of collateral, and those treasury bonds are collateral, which banks need in order to do their monetary transactions. As mortgage-backed security was no longer pristine collateral, the only one collateral which was left as a risk-free is a treasury. So the bond market expects that Federal Reserve will be involved in every step. Every time there is a deflation on the horizon and the market is about to collapse, Federal Reserve will come to rescue. They will print as much money as necessary. They will buy as many bonds as necessary in order to maintain the current asset prices. So it means as long as US dollar remains stable and strong, there's no reason to believe that yields will not go even lower. And of course, most of the people in the bond market are highly intelligent people. They are brilliant mathematicians. They are brilliant economists. What I would think they might be lacking is of politics and how economic equality might affect United States in the future. They are not occupying themselves with those topics. They only look at the facts and what market indicates to them. From my side, when I invest, I'm pricing in probability that the United States government will continue those fiscal and trade deficits, and that might eventually collapse the US dollar. Bond market will not be pricing it in until they actually see the robust facts besides the speculation on the politics. And they would actually be partially right. You saw a lot of social changes. You saw presidential term of Barack Obama, who brought huge deficit. Donald Trump, huge deficits. Joe Biden, top deficit. And still, CPI remained on relatively low level, and economists explained this jump to 5.4% simply by supply chain disruption due to COVID. So you can understand them and the way they look at things. It just, I'm looking at those same things a little bit differently with the context of probabilities for US dollar to eventually collapse in the present system. I hope you like this video. Thanks a lot and see you in the next one. Bye bye.